You're scrolling through social media at midnight when a thought creeps in that you can't quite shake. Someone you went to high school with just bought a house. Someone from your first job just announced they're retiring early. Someone younger than you posted about hitting a net worth milestone that feels impossibly far from where you are. You do the math in your head. You count the years until 40. You wonder if you're behind, if you've missed something, if everyone else got a financial playbook you never received. Here's what's actually happening. You're measuring yourself against milestones that don't matter while ignoring the ones that do. The internet is full of arbitrary benchmarks. Have $1 million by 30, own a home by 28, retire by 45. These numbers sound impressive, but they're disconnected from how real financial security actually works. They're designed to make you feel inadequate, not to help you build a life you actually want. The milestones that matter aren't about hitting specific dollar amounts by specific ages. They're about putting systems in place that create lasting stability, flexibility, and freedom. They're about reaching checkpoints that fundamentally change your relationship with money, regardless of your income level or starting point. This video covers 9 financial milestones that actually matter before you turn 40. Some will seem obvious, but are harder to achieve than people admit. Some will challenge assumptions you didn't know you had. A few might completely reframe how you think about what financial success even means. If you're under 40, these milestones are your roadmap. If you're over 40 and haven't hit them all, you're not behind. You've just been operating without clear targets. Either way, by the end of this video, you'll know exactly what to focus on and what to ignore. The first milestone is the foundation everything else builds on. Zero high-interest debt. Not zero debt entirely. We'll talk about mortgages later. Zero high-interest debt. Credit cards, personal loans, car payments at punishing rates. Anything above 6 or 7% interest is actively working against you every single day. This isn't just about saving money on interest payments, though the math there is brutal enough. Carrying a $10,000 credit card balance at 22% APR costs you over $2,000 annually just in interest. That's money disappearing into nothing. That's money that could be compounding in your favor instead of against you. But beyond the math, high-interest debt creates psychological weight that affects every financial decision you make. It's an anchor. It limits your options. It forces you to stay in jobs you hate because you can't afford the risk of leaving. It makes emergencies into catastrophes because you have no buffer. The average American carries over $6,000 in credit card debt. The average credit card interest rate in 2026 exceeds 22%. If you're in that average, you're paying over $1,300 annually just to service debt that's probably funding purchases you've already forgotten about. Here's what you do. List every debt you have with its interest rate. Attack the highest rates first. This is called the avalanche method, and it saves you the most money mathematically. Or attack the smallest balances first if you need psychological wins to stay motivated. That's the snowball method. Either works. What doesn't work is making minimum payments indefinitely while hoping the problem solves itself. Before you can build wealth, you have to stop the bleeding. This milestone isn't glamorous. Nobody posts about paying off their credit card on social media, but it's the checkpoint that makes every other checkpoint possible. The second milestone protects everything you build, a fully funded emergency fund. If you lost your job tomorrow, how long could you survive without panic? 2 weeks? A month? That's not financial security. That's a house of cards waiting for a breeze. The standard advice says 3 to 6 months of expenses. I'd push that higher. 6 to 12 months if you can manage it. Not because I'm pessimistic, but because real emergencies rarely arrive one at a time. Job loss often coincides with health issues or family crises. Economic downturns affect multiple income streams simultaneously. The cushion you think is enough usually isn't. Calculate your actual monthly expenses: rent or mortgage, utilities, food, transportation, insurance, minimum debt payments. Multiply by at least 6. That's your target. Put it in a high-yield savings account earning 4 to 5% APY in 2026, not sitting in checking earning nothing. This money isn't for opportunities. It's not for investments. It's not for that vacation you've been wanting. It's insurance against catastrophe. It's the difference between an emergency being a stressful inconvenience and an emergency destroying years of financial progress. The psychological benefit of this milestone extends beyond the practical protection. When you have 12 months of expenses sitting in reserve, you make different decisions. You negotiate harder at work because you're not desperate to keep the job at any cost. You take calculated risks because failure won't mean financial ruin. You sleep better because unexpected expenses don't spiral into debt. Half of Americans can't cover a $1,000 emergency without borrowing. Don't be half of Americans. The third milestone shifts your entire financial trajectory: career income optimization. Your income is your most powerful wealth-building tool. It's not stock picks or crypto or real estate strategies. It's the money flowing into your life every month from the work you do. Optimizing that income changes everything else. By 40, you should be earning significantly more than you did at 25. Not just from inflation adjustments, but from genuine advancement in skills, responsibility, and market value. If your income has been flat for 5 years despite gaining experience, something is wrong, either with your career path, your negotiation habits, or your willingness to change employers. The median income for Americans in their 40s is around $69,000. If you're significantly below that without specific circumstances explaining why, this milestone deserves aggressive attention. Here's what career optimization actually requires. Get genuinely good at your job. Not just adequate, but excellent. The people who advance fastest are the ones their employers dread losing. They're not just doing the work. They're making themselves irreplaceable through expertise, relationships, and results that are difficult to replicate. Negotiate your salary at least annually. Most people accept whatever they're given and wonder why their income stagnates. The raises you don't ask for are money you'll never see. Prepare data on your contributions, research market rates for your role, and make the case professionally. Even small percentage increases compound dramatically over a career. Consider whether your current path leads where you want to go. If you've been at the same company, same level, same approximate salary for years, that's not stability, it's stagnation. Sometimes the biggest income jumps come from changing employers, changing industries, or changing your approach entirely. The difference between earning $50,000 and $70,000 annually is $20,000 per year. Over 20 years, invested at average market returns, that difference becomes over $1 million. Career optimization isn't just about immediate lifestyle. It's about the compounding effect of higher income over decades. The fourth milestone transforms wealth building from intention to inevitability: full financial automation. Investing shouldn't require willpower. It shouldn't require monthly decisions about whether to contribute. It shouldn't require you to remember, to transfer, to actively choose each time. It should happen automatically, invisibly, consistently, like breathing. The secret to building real wealth isn't finding the next hot stock or timing the market perfectly. It's boring, automated, regular contributions to diversified investments over long periods of time. The people who become millionaires through investing are rarely the ones making brilliant moves. They're the ones who set up automatic transfers decades ago and let compound growth do the work. Here's your automation checklist. Contribute at least 10 to 15% of your income to retirement accounts, 401k, Roth IRA, or both. Set these contributions to happen automatically from your paycheck or bank account. You shouldn't have to think about it or remember it or decide each month whether you can afford it. Max out employer matching if your company offers it. This is free money. Leaving it on the table is the equivalent of refusing a raise. If your employer matches 50% up to 6% of your salary, contributing less than 6% means you're voluntarily taking a pay cut. In 2026, the 401k contribution limit is $24,500. The Roth IRA limit is $7,000. If you can max both, do it. If you can't, contribute what you can and increase by 1% every year. The beauty of automation is that it removes you from the equation. You don't have to be disciplined every month. You don't have to resist the temptation to spend instead of invest. The system handles it. Your job is just to live on what remains after the automatic transfers happen. By 40, your retirement account should hold at least 3 times your annual salary. If you earn $70,000, that's $210,000 invested. This gives you roughly 25 years of compound growth before traditional retirement age, enough time for that money to potentially multiply several times over. The fifth milestone protects your family and clarifies your priorities. Basic estate planning. This sounds morbid. It sounds like something for older people or wealthy people. It's neither. If you have any dependents, any assets, or any preferences about what happens if you're incapacitated, basic estate planning matters now. A will doesn't have to be complicated. At minimum, it specifies who gets your assets, who handles your affairs, and, critically, who takes care of your minor children if something happens to you. Dying without a will means the state decides these things according to default rules that may not match your wishes. A healthcare directive specifies your preferences if you can't communicate them yourself. A power of attorney designates who can make financial decisions on your behalf if you're incapacitated. These documents aren't about being paranoid. They're about ensuring the people you love aren't left navigating legal complexity during the worst moments of their lives. You can create basic versions of these documents online for minimal cost and have them notarized at a UPS store. If your situation is complicated, blended families, significant assets, business ownership, work with an attorney. Either way, having something is vastly better than having nothing. Think about it this way. If you died tomorrow without a will, your grieving family would have to petition a court to handle your affairs. They might not know where your accounts are. They might not have access to passwords. They might disagree about what you would have wanted. The state would appoint someone to manage your estate, possibly someone you wouldn't have chosen. None of that is what you want for the people you love. 15 minutes of planning prevents years of potential chaos. The sixth milestone shapes your daily life more than any account balance: avoiding lifestyle inflation. This is where most people sabotage themselves without realizing it. Their income grows and their expenses grow to match. Every raise funds a slightly nicer apartment, a slightly better car, slightly more expensive habits. The gap between income and spending stays constant even as both numbers increase. The result is predictable. Someone earning $150,000 feels just as stretched as they did earning $60,000. They're not saving more. They're not building wealth faster. They're just consuming at a higher level while remaining exactly as financially fragile as they've always been. The millionaires studied in research consistently share one characteristic: they don't spend like millionaires. They live below their means regardless of how much those means grow. They drive Toyotas and Hondas. They live in modest homes relative to what they could afford. They accumulate wealth precisely because they don't feel compelled to display it. Here's the math that should terrify you. If someone earning $200,000 saves 10%, they're building wealth on $20,000 annually. If someone earning $80,000 saves 30%, they're building wealth on $24,000 annually. The lower earner builds wealth faster because they've resisted lifestyle inflation. When your income increases, celebrate briefly and then redirect most of that increase to savings and investments. Keep your baseline expenses relatively stable. The gap between what you earn and what you spend is where wealth actually comes from. Protect that gap aggressively against the constant pressure to upgrade everything. This doesn't mean living in deprivation. It means being intentional about what you upgrade and why. Spend generously on things that genuinely matter to you. Refuse to spend on things that don't. The clarity about what actually matters to you, your personal no list, saves you from mindless consumption that provides no lasting satisfaction. The seventh milestone applies to anyone in a partnership: financial alignment with your partner. Money is one of the leading causes of relationship conflict and divorce. Most couples wait until there's a problem to discuss finances, by which point positions have hardened and resentment has built. If you're in a relationship, financial alignment isn't optional. It's a milestone as important as any account balance. This means both partners understanding your complete financial picture: income, expenses, debt, investments, goals. Not one person handling everything while the other remains uninformed. Both people engaged, both people aware, both people participating in decisions. Schedule regular money conversations. Monthly is a good cadence. Review what came in, what went out, where you stand relative to goals. These conversations shouldn't be confrontational. They should be collaborative check-ins where you're working as a team towards shared objectives. Create shared visibility into your finances. A spreadsheet, an app, a dashboard. The specific tool matters less than both partners having access to the same information. Hidden finances breed distrust. Transparency builds partnership. Discuss your rich life visions and make sure they're compatible. If one partner dreams of early retirement through aggressive saving, while the other wants to enjoy life fully now, that tension will surface eventually. Better to identify it early and find compromises than to discover fundamental disagreements years into a financial plan. When both partners are engaged with money, you make better decisions. You catch potential problems earlier. You hold each other accountable. You celebrate wins together. Money becomes something that connects you rather than something that creates conflict. If you're the money person in your relationship and your partner is disengaged, that's a risk, not just to your relationship, but to their security if something happens to you. Bring them in. Share the knowledge. Build the capability together. The eighth milestone often gets ignored until it's too late: investing in your health. This isn't directly a financial milestone, but it has massive financial implications. Healthcare costs are one of the largest expenses in retirement. Chronic health conditions reduce earning capacity and quality of life. Living longer in good health means more years to earn, save, and enjoy what you've built. The return on investment from health habits is enormous. Regular exercise, reasonable nutrition, adequate sleep, stress management, these are essentially free interventions that reduce your lifetime healthcare costs by potentially hundreds of thousands of dollars. Your 30s and 40s are when the foundation for later health gets established. The habits you build now, the conditions you prevent now, the baseline fitness you maintain now, all of this pays dividends for decades. This is also when your body starts sending signals you might not have received before. Recovery takes longer. Injuries happen more easily. The metabolism that forgave bad habits in your 20s becomes less forgiving. Pay attention to those signals. Get regular checkups. Address problems early rather than waiting until they become serious. Think of health maintenance as financial planning for your physical self. The most common regret of people in their 60s and 70s is not taking better care of themselves earlier. They have the money to travel, but not the body. They have the freedom to enjoy life, but chronic conditions limiting what they can do. Don't let that be you. The ninth milestone brings everything together: having a clear financial vision. What is all of this for? What's the point of the saving, the investing, the career building, the milestone achieving? If you don't have a clear answer, you're just accumulating numbers without purpose. Your financial vision is the life you're trying to build, not a dollar amount, a life. What does freedom look like for you specifically? What would you do with your time if money weren't a constraint? What experiences matter most? What legacy do you want to leave? Some people want to retire early and travel extensively. Some people want to work on passion projects without worrying about income. Some people want to help their kids avoid student debt. Some people want to give generously to causes they believe in. Some people want security above all else, the peace of mind that comes from knowing they're protected against catastrophe. All of these are valid. None of them are universal. Your vision is yours. Once you have that vision, you can calculate your freedom number, the amount of invested assets needed to support that vision indefinitely. The standard calculation is to multiply your annual expenses by 25. If your ideal life costs $80,000 annually, you need roughly $2 million invested to sustain it through the 4% withdrawal rule. That number might seem distant. That's okay. The point isn't to feel bad about where you are, it's to have a clear target you're working toward. Every milestone on this list moves you closer to that target. Every year of progress compounds on previous years. Revisit your vision annually. What you want in your 30s will evolve in your 40s. Your priorities will shift as circumstances change. That's not inconsistency, it's growth. The vision should be a living document that adapts as you do. These 9 milestones aren't about hitting arbitrary numbers by arbitrary ages. They're about building systems that create lasting financial security. Zero high-interest debt removes the anchor dragging you down. A full emergency fund protects against catastrophe. Career optimization maximizes your primary wealth-building tool. Financial automation makes investing inevitable rather than optional. Basic estate planning protects the people you love. Avoiding lifestyle inflation preserves the gap where wealth accumulates. Partner alignment prevents money from destroying relationships. Health investment extends your earning years and quality of life. A clear vision gives everything else meaning and direction. If you're approaching 40 and you haven't hit all of these, don't panic. These milestones aren't pass-fail tests with expiration dates. They're checkpoints on a journey that continues regardless of your age. Someone starting at 45 with clear targets will build more wealth than someone who drifted aimlessly from 25 to 65. What matters is moving forward intentionally. Pick the milestone you're furthest from achieving and focus there first. Build momentum through small wins. Let progress compound. Everything in this video is financial literacy applied to life planning. Most people never think systematically about what financial checkpoints actually matter. They absorb random advice from random sources. They measure themselves against benchmarks that don't apply to their situations. They feel vaguely behind without knowing exactly what they're behind on or how to catch up. Understanding which milestones matter and which don't is itself a form of financial education that most people never receive. It's the difference between wandering and navigating, between hoping things work out and building systems that make success likely. I made a complete breakdown of financial literacy that goes deeper on all of this. Not just the milestones themselves, but the underlying principles that make everything work. How compound growth actually functions. How to evaluate financial advice. How to build the knowledge base that lets you make confident decisions for the rest of your life. If this video gave you clarity about what to focus on, that video will give you the complete framework for understanding why these things work and how to optimize them for your specific situation. Because the truth is, turning 40 isn't a deadline, it's a checkpoint. The question isn't whether you've arrived by some arbitrary age. The question is whether you're on a clear path, making consistent progress, building systems that serve you. These 9 milestones give you that clarity. They tell you exactly what matters and what doesn't. They transform vague financial anxiety into specific, actionable targets. Most people spend their 30s hoping things work out. The ones who build real security spend their 30s making sure things work out. You've got the roadmap now. The only question is whether you'll use it.